Hi, this is Kirubakaran Rajendran. Welcome to another video series with Groww. So basically, most of the traders who are now directly trading with the markets, their main problem is dealing with uncertainty. So market is all about we never know what's going to happen tomorrow. So that is why most traders use these kind of stop losses, so that if market goes against them, it somehow cut short their overall loss. So in order to handle these uncertainty in the markets, one of the best tool that can be used by traders is hedging. So what we are going to talk about in this video is what is hedging and how it can be really useful for traders. So let me explain with an example how you can use hedging if you're an option trader. So currently, Nifty is trading at the spot price of 18,534. So what I'm trying to do is I'm going to short the current call option at the money strike. So 18,550 call option, which I'm trying to sell. So once I add the position, the option price is 96 rupees. So now as you could see, so the next expiry, which is on June 8, currently it is June 4th. So what happens is in the next 4 days, if the market doesn't cross beyond 18,550, if market continue to trade below this level, then you make a profit of around 4,800 rupees, where you're paying a margin of 98,000. So you're almost paying 1 lakh to make almost 4% returns. So the probability of profit here is almost 67%. But if the market goes against you, if the market continues to go up, then your maximum loss is undefined, which means the maximum loss is unlimited. So if your view goes wrong, there is a huge potential, or there is a huge chance that you could lose much higher money. So now how do I protect this? By using a hedge mechanism. So in this case, what I'll do is I'm shorting at the money call option 18,550, and then I'll buy an 100 points away OTM options, so which is trading approximately 48 rupees. So now if I add this position, as you could see, now my downside is protected. So the maximum loss is now only 2,600 rupees and maximum profit is 2,300 or 2,400 rupees. And the best part is the overall margin requirement has gone down almost 4 times. So almost from 1 lakh overall margin, now it is reduced to almost 23,400 rupees of overall margin. And even the probability of profit, earlier it was 67% probability of profit, now it is 60%. So only 7% we have lost in the overall probability of profit, but still you have a very good chance of 60% making money in this trade, as long as Nifty trades in this below zone. So as long as Nifty trades below 18,600 levels, you will make money. And if it crosses, if your view goes wrong and if market continues to move up, still your maximum loss is not going to cross more than 2,600 rupees. So this is what hedging is. So just like how you are buying car insurance to avoid any unforeseen event or big damage to your car, so similarly in this trade, to avoid any big damage to your trade, to avoid any big loss, you are buying just 100 points away call option to protect the overall downside risk. So by doing this trade, so you are totally removing the uncertainty part. You are not removing the loss completely, but you are removing the uncertainty, because it clearly tells you the maximum loss is just 2,600 rupees. But when we totally remove this hedging part, you see that your total loss can go unlimited. As long as market moves against you, it could give you unlimited loss. So let me explain with another example how, if you are specifically people who are dealing with the short straddle systems, shorting at the money call option and shorting at the money put option. Basically, these people use 920 variation of strategies, where once they do a short straddle, they use a fixed stop loss on either side. 25% stop loss on call side, 25% stop loss on put side, so that if market moves in one-sided direction, they tend to make money. But the problem with this type of using a stop loss based trading system is when market suddenly jumps, when market suddenly moves 200 300 points within a short span of time, then that can jump the stop losses. It might not get filled. So that is why you can use hedging with respect to short straddle system also. So let me explain how you can use hedge to control the overall loss if you are not trading a short straddle system. So let's consider if you are doing a short straddle system, which is I'm shorting at the money call option and at the money put option. So currently the at the money call option is 18,600. So I'm going to short 18,600 call and 18,600 put. So I'm shorting at the money call option. So both call and put is added. So as you could see, so I've shorted 18,600 call and 18,600 put. So both are almost trading at the same price. So as long as market is oscillating between this tight range, I tend to make profits. So with this short straddle system, the overall required margin is approximately 1.2 lakhs. And the expected profit, the maximum expected profit is around 8,300 rupees, which is approximately around 6% on the overall margin. So the maximum loss, so what happens is, you can use 25% stop loss or 30% stop loss on the premium, where from 80 rupees, if it moves to 100 rupees, you'll exit. So your overall premium risk is 20 rupees on call side, on 20 rupees on put side. So that is what most of the traders use. But as I said earlier, if market suddenly moves, then your stop loss might be jumped. Then you might not end up with 20-point stop loss. You might end up with a higher stop loss, higher losses. So let's add hedge to this system. Like, how do I add an option buy to this specific strategy so that I'll also get margin benefit and also my overall maximum loss is protected? Because here the maximum loss is undefined, which means if market suddenly tanks big time, then this position can be now under a very big loss. So what I can do is, instead of 18,600 call and 18,600 put, I can buy just 200 or 300 points away OTM. So instead of 18,600, say suppose if I'm buying 18,900 call. So 18,900 call is trading around 7 rupees. So just add. So I'm just adding 18,900, and again, so instead of 18,600 put, I am adding 18,300 put. So basically we are buying 300 points away OTM options to hedge this position. So now if you see, so I'm initiating the same short straddle, which is at the money call option and at the money put option, but instead I'm just buying 300 points away call option and 300 points away put option, so that my downside is protected. So earlier my maximum loss was undefined. Like, if market keeps moving in one sided direction on the downside or on the upside, then I might end up in very big loss. But here my maximum loss is capped, which is 7,600, and my maximum profit is also capped, which is almost same, say 7,400. So with almost 1:1 risk reward ratio, with the 45% of overall probability, you are locking your overall loss here. Your risk is defined. You're removing the uncertainty here. In addition to that, you get the margin benefit also, where you are instead of 1.2 lakhs per lot earlier without any hedge benefit, now you are shorting the same at the money call option and at the money put option with hedge. So your estimated margin has come down to 56,000. So from 1.2 lakhs, it has almost come down to half of it. So which is just 56,000. If you have enough, this 56,000 of capital, then you would be able to execute this trade, which gives you a maximum profit of 7,400, and maximum loss is totally capped at 7,600. So that is how hedging can be used. So hedging can be used not only on directional trade, even on non-directional trades like this, you can use hedging. So consider if you are a futures trader. So can hedging be used only with options? No, it can be used with futures also. So if you're directly dealing with futures trader, mostly you will be a directional trader, because with futures you can't deal with non-directional systems. You have to take a direction. You have to go long or you have to go short. So you have to have a bearish view or you have to have a bullish view. So in case if you're a futures trader, let me explain how option can be helpful for you to protect your futures long or futures short. So how you can use these options to use it as a hedge and also to control the overall required margin. So let's consider you are going long on Nifty. So currently Nifty with around 18,600 levels. If you are going long, now I'm just selecting the futures. I've selected buy and just adding the position. So this is the position. So as you could see, I'm just plain long here. So the maximum profit is undefined, the maximum loss is undefined, which means that as long as the market goes up, I tend to make higher profits. But if the market tends to reverse, if it goes down, then I tend to make a very high loss. And the overall required margin is around 1,04,500 rupees. So this is your view where you state that the market is bullish. So now, how do I use options to make it as a hedge, and how do I protect this trade? So let me see. What I'll do is, so currently the futures price is 18,631. So we are going long at around this price level. So now, in order to have a hedge, I'm just buying 200 points away put options here. So I just go and select options. So instead of 18,600, I'll just buy 18,400 put option, which is trading approximately around 82 rupees. So I added a buy here, and if you scroll down, now if you could see, the maximum loss is capped. So approximately my maximum loss is around 15,000, and also the required margin drastically reduced. So from 1 lakh, now it is just 32,000, because we are buying a put option which is not very far from our current spot, which is just 200 points away from the spot. So if market goes below this level, so for an example, if market goes below 18,300 level, 18,200, 18,000, 17,000, wherever it goes, no matter what, your maximum risk is capped at 15,690. So that is your maximum loss. But on the upside, as long as your direction is right, you tend to make big money in this trade. So the same futures trade, but I'm using these OTM options or options which is near to the spot. By using that, we are able to control the maximum downside, and also we are able to bring down the required margin. So if you wanted to deal with the option selling system and you wanted to have a completely hedged positions, then you can try any of these non-directional systems like Ironfly, where if I just click on Ironfly, it will automatically populate what is the required margin that I need to know, what is the required strike that I need to short, required strike that I need to buy, and everything comes up here. So let me show you with an example here. So I've just added Ironfly here. So which shorted at the money call option, 18,600 call option and 18,600 put option, just like how I explained in the first example. So now it automatically bought 150 points away call option and 150 points away put options to protect the downside, so that your risk reward ratio increases. It is not equal, it is more than double. For an example, your maximum loss as per this strategy is just 2,000 rupees on the downside, but on the upside you tend to make almost 5,000 rupees, so almost more than 2 times of what you are risking. And also the estimated margin also gone down from 1.2 lakhs to almost 47,000. So with this position, as long as market moves in this tight zone, like when you are expecting market to be in a very narrow range, you can apply this kind of strategies where it is totally hedged and your downside is also protected, and also your risk reward ratio is much higher. So this is what I wanted to convey in this video. So hope you understand what hedging is all about and how traders are applying these hedging in their option trading system and then in their futures trading system. So if you are trading with the naked options, start avoiding that and start including these kind of hedging mechanisms, so that it would try to help you from downside protection. And also if there are any certain uncertainty that happens in the markets, if market suddenly goes down or goes up very quickly, these kind of hedging mechanism can greatly help you to protect the downside. So in case if you guys have any questions, please post it in the comment section. I'll address it. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.